Hi there, I'm Julie Price, and welcome to Juniper's Economic and Market Review as of March 31st, 2025. Thanks for tuning in as we break down what's been going on in the economy and markets and what that could mean for you. We kicked off the year with some momentum, but things have gotten a little bit bumpy. Between new tariffs, a pullback in stocks, and signs of slower economic growth, there's a lot of chatter about recession risks and inflation rearing its head again. Businesses are still hiring, though not as quickly, and consumers seem to be taking a bit of a breather on spending. Inflation cooled a bit in February, but has generally been ticking up since the fall. That, plus some political uncertainty, led the Federal Reserve to keep interest rates steady in the first quarter. In the stock market, the once high-flying Magnificent Seven stocks stumbled, pulling the S&P 500 into correction territory after reaching all-time highs earlier this year. Meanwhile, international markets like Europe and China got a boost, but we'll see how long that lasts. With so many unknowns, it's more important than ever to focus on the fundamentals. A diversified mix that includes bonds and international holdings can provide some cushion during rocky times in U.S. equities. In this video, I'll walk you through what's been happening with growth, jobs, inflation, and how the Trump administration's policies might shape what comes next. Then we'll touch on what the Fed's up to and where we see opportunities around the globe. Volatility is expected in the markets, but the first few days of the second quarter have tested the limits of investors' patience. Before we delve into the first quarter results, I'm going to spend some time discussing how we can view short-term volatility through a long-term lens. Hang in there, markets may be noisy, but that doesn't mean we need to be. As always, I'll be using JP Morgan's Guide to the Markets. Feel free to pause the video if you would like to take a look at the slides. All right, let's delve in.
This chart depicts annual returns of the S&P 500 in gray, with the worst days of the year in red. In 1996, the market returned 20%. However, at one point in the year, the market was down 12%. On the day that the market was down like that, imagine an investor's joy if only they knew that the year would end up plus 20%. Or in 2020, with a pandemic low of 34% compared to the actual calendar return of 16%. Scan over the many years of positive calendar year returns in gray compared to their intra-year lows in red. Yes, there are some bad years in there, but 2025 is far from over. Do be aware of what is happening in the economy and markets, but this slide illustrates why not to allow day-to-day volatility to weigh on you. This slide shows the 74-year range of stocks in green, bonds in blue, and a 60% equity, 40% fixed income balanced portfolio in gray over rolling time periods. If you take shorter rolling one-year time periods like 2017, 2018, 2019, etc., you have a great range of outcomes. Historically, stocks have ranged from a high of 52% to a low of negative 37%. Bonds range from 33% to negative 13%, and the 60-40 stock bond mix is somewhere in between, ranging from 34% to negative 20%. Looking at 5-year rolling time periods like 5 years starting in 2017, 5 years starting in 2018, 5 years starting in 2019, etc. The range decreases substantially. Stocks range from 29% down to only negative 2%. The lower range of the balanced portfolio is low but still positive. The range gets tighter as the rolling periods lengthen. When you get to the rolling 20-year period, the balanced portfolio ranges from a high of 15% to a low of 5%. This chart illustrates why investors should focus on the long term and less on the day-to-day noise of market volatility. The gross domestic product, or GDP, is like the nation's paycheck. It shows how much we're earning as a country. Steady GDP growth keeps the economy humming along. JP Morgan predicts growth will be pretty flat for the first quarter of 2025, and it might even dip slightly negative in the second quarter. Now, 2 negative quarters in a row could technically signal a recession, but it's not the whole story. Economists have other clues they look at. The last time we saw a negative quarter was way back in early 2022, so we've been on a decent run. So, what's driving GDP? Consumer spending is the star of the show, making up nearly 70% of the economy. Thanks to growing household wealth and 22 months of wages outpacing inflation, shoppers have been flexing their wallets, boosting the economy by 4.2% in the last quarter of 2024. Businesses, though, hit the brakes on big investments, probably feeling the pinch from higher interest rates. On the flip side, the housing market is showing signs of life after a tough couple of years. Lower mortgage rates could spark some action, though fewer new homes are being built, and a drop in immigration might cool demand. Government spending has been a helper lately, but don't expect a big encore. Budget cuts are looming. Here's the plot twist. Uncertainty about new policies is making things foggy. Businesses are stocking up on imports, maybe to dodge future tariffs, which could drag down first quarter growth. Plus, car and retail sales slowed in February, and consumer confidence took a bit of a nosedive. It's like the economy's downshifted from a sprint to a jog. Is this just a return to normal or a sign of bumpier roads ahead? Time will tell, but we're keeping a close eye on it for you. The unemployment rate has been remarkably stable, hovering around 4% for most of the past year. At 3.9% in March, it's a bit higher than the cycle low of 3.4% we saw in April 2023. But let's keep it in perspective. It's still lower than almost 90% of the time over the past 50 years. Last year's uptick in unemployment can be seen as a normalization after an economy running a bit too hot. As we move through 2025, job growth might slow alongside a cooling economy, but it's expected to remain positive. Layoffs have stayed low, and even if they tick up, slower labor force growth, partly due to stricter immigration policies, might help offset any significant rise in unemployment. If economic conditions hold steady, we could even see unemployment drift lower by year's end. A looser labor market has helped bring wage growth back down to earth. After hitting 7% in March 2022, wage growth has moderated to more typical levels around the 50-year average. Slower immigration could put some upward pressure on wages, but with strong productivity gains holding steady, this is unlikely to spiral into inflationary pressures. The bottom line, the labor market appears resilient, but not immune to broader economic forces. For now, it's a case of steady as she goes, but as always, we'll keep a close watch on developments. The labor market has settled into a healthier rhythm after its post-pandemic boom. Job growth has normalized, but the Trump administration's push to significantly reduce immigration could have lasting effects on the labor market in 2025 and beyond. Labor supply in the U.S. staged an impressive comeback after the pandemic, thanks largely to increased immigration. Of the 10.6 million individuals who joined the labor force between January 2021 and January 2025, 54% were born outside the U.S. This influx of foreign-born workers helped employers fill job openings without driving wages higher, which explains why strong job creation hasn't led to runaway inflation. However, restrictive immigration policies could slow labor force growth, especially given weak domestic demographics, potentially leading to higher wages and slower economic growth. The impact is already visible. Southwest land border encounters dropped to under 12,000 in February, compared to averages of 100,000 per month in late 2024 and over 250,000 per month in late 2023. On another note, the labor force participation rate has seen a strong recovery, boosting labor supply. While the aging baby boomer generation has kept overall participation below pre-pandemic levels, prime age workers have fully regained their pandemic losses. Looking ahead, Employment growth is likely to slow throughout 2025, but solid corporate profits could prevent a complete collapse. That said, sharply reduced immigration could create a stagflationary effect, slowing economic growth while pushing inflation higher. S&P 500 earnings turned in an impressive performance in 2024, growing by 10% overall and finishing strong with a fourth quarter earnings season that saw a remarkable 18% year-over-year increase and a 5% quarter-over-quarter rise. The star of the show here, margins, which contributed over 13 percentage points to the growth. But the story gets even more interesting when you dig deeper. Earnings have continued to broaden. The Magnificent Seven stocks saw their earnings rise by a whopping 31% year-over-year. But even outside of this group, earnings grew a solid 15%. Notably, 10 out of 11 S&P sectors contributed positively to growth, with financials leading the charge. This diversification sets a positive tone heading into 2025. Looking ahead, analysts project even stronger growth, 11% in 2025 and 14% in 2026. While these numbers sound enticing, it's important to take them with a grain of salt. Earnings are cyclical, and these estimates may be overly optimistic, especially considering the slowing nominal GDP growth we anticipate. Normalizing GDP growth could put a cap on revenue growth, and rising input costs from tariffs could squeeze margins despite the relief of corporate tax cuts. Companies may face challenges in exceeding these lofty expectations. Inflation has been on the move lately, rising more quickly in recent months, though it's still well below its peak. Headline CPI came in at 2.8% year-over-year in February, slightly better than expected and down from January's 3%. While that's progress, it's still above the 2.4% we saw last September. Looking ahead, tariffs could push inflation higher, so we're not necessarily out of the woods yet. Core goods prices were a consistent source of deflation throughout 2024, but have shifted upward recently. The culprits? New and used vehicle prices, which have been feeling the heat from increased replacement demand following hurricanes and wildfires. Energy and food inflation, the more volatile components of CPI, have also been running hot, but thankfully cooled a bit in February. With tariffs affecting the global economy, these categories could see further price hikes in the months to come. Shelter and auto insurance remain key contributors to inflation. Shelter, which makes up more than a third of the CPI basket, has shown signs of easing but remains stubbornly above pre-pandemic levels. However, real-time measures of market rent suggest more normal trends in shelter inflation may be on the horizon. Auto insurance inflation, while cooling, still rose 11.8% year-over-year in February, though a continued drop in vehicle prices should help ease this pressure. Overall, while progress on disinflation is encouraging, the journey to 2% could be a bumpy ride, particularly with tariffs adding friction. Based on current trends, inflation at or above 3% by year's end isn't off the table. For years, global trade was like a big open marketplace, with tariffs, the taxes on imported goods, shrinking since the 1930s. But lately, things like COVID supply chain chaos and geopolitical spats have thrown a wrench in that free trade party. Enter the Trump administration, which is all about protecting American businesses with a hefty dose of tariffs. This slide gives you the history of tariffs over the last 25 years. Tariff news is like a soap opera, new twists daily. There are tariffs on about 90 countries, now on pause. There's a 25% tariff on goods from Mexico and Canada. Energy gets a pass. 10% on Canadian energy and 145% on China, with retaliatory tariff from China of 125%. Plus, we've got 25% tariffs on steel, aluminum, and autos. Are these permanent or just bargaining chips? It's anyone's guess, but tariffs are definitely up and they might climb higher. Here's the catch. Tariffs can make imports pricier, which could nudge inflation up. They might also spark trade wars, slowing demand for U.S. exports. It's like trying to dance on a tightrope in a fog, tricky for the economy and the Federal Reserve. Bottom line, tariffs are stirring the pot, adding extra uncertainty to an already cloudy outlook. Among the Trump administration's expansionary fiscal policies, extending the Tax Cuts and Jobs Act, TCJA, and reducing the corporate tax rate are front and center. There's also a promise to dramatically cut costs through the Department of Government Efficiency, or DOGE. This slide helps us evaluate the feasibility of these proposals and their potential impact on the fiscal health of the U.S. On the left, we see CBO estimates for government spending and how it will be financed in fiscal 2025. To achieve its cost-cutting goals, the administration may face tough choices. Non-defense discretionary spending makes up just 14% of the budget, meaning cuts to defense or entitlements might be on the table. Early efforts by DOGE have focused on reducing the federal workforce, but with federal employee compensation accounting for less than 6% of the budget in 2024, the savings are likely to be minimal. The administration also plans to use tariff revenues to offset the TCJA extension. However, tariffs contribute only a small fraction of government revenue, and that's unlikely to change. Higher tariffs could invite retaliation, slowing the economy and reducing income tax revenues, a classic case of unintended consequences. On the right, without revenue or spending offsets, the TCJA extension would act as significant stimulus, adding to deficits. Each year's deficit adds to the overall federal debt, which the CBO projects will reach nearly 120% of GDP by 2035 without the TCJA extension, and nearly 130% with it. That's up from 98.2% in fiscal 2024. Since the TCJA extension and other provisions must pass through the annual budget reconciliation process, they likely won't take effect until early 2026. However, a slowdown in economic activity could prompt additional fiscal stimulus before then. While expansionary fiscal policy might boost growth in the short term, it could also drive deficits higher and act as a longer-term source of inflationary pressure. The real problem is that the government spends more than it takes in. As a result, we have no other choice but to import more than we export. The trade deficit is an us problem, not a them problem. Until that is remedied, we will continue to have a trade deficit. The takeaway? These policies could reshape the fiscal landscape, and without careful planning, the budget might feel like it's chasing its tail. The Federal Reserve finds itself in a challenging position as we head into the second quarter. After delivering 100 basis points of rate cuts in 2024 to support the economy, the Fed is now grappling with slowing economic activity and a stalling disinflation process in early 2025. While the committee prefers to ease policy toward a neutral stance, fiscal stimulus and policies around tariffs and immigration may complicate their efforts. As widely expected, the Federal Reserve voted in March to keep the federal funds rate steady within a range of 4.25% to 4.5%. Tariffs are a significant consideration, and the Fed's updated summary of economic projections reflects this, with near-term expectations of slower growth and higher inflation. The 2025 growth forecast has been downgraded from 2.1% to 1.7%, and headline and core inflation forecasts have risen by 20 and 30 basis points, respectively. Longer-term inflation forecasts, however, remain largely unchanged, indicating the Fed currently views any tariff-induced inflationary pressure as transitory. With uncertainty clouding the outlook, the Fed left its dot plot unchanged, reflecting expectations for 2 rate cuts in both 2025 and 2026, and 1 cut in 2027. On the balance sheet side, the committee announced it would slow the pace of quantitative tightening. Currently, markets are pricing in just under 3 rate cuts for 2025. This reflects 2 scenarios being considered by investors. If inflation stays elevated and economic resilience holds, the Fed could deliver just 1 or 2 cuts this year. However, a more serious economic downturn may lead to a more aggressive rate-cutting cycle. For now, the Fed's balancing act between supporting growth and managing inflation continues to keep markets on edge. After a stellar rally in 2024, concerns about an economic slowdown caused credit spreads for investment grade and high-yield bonds to widen slightly in the first quarter of 2025. Despite this, both sectors remain up more than 1% year to date, and spreads are still tight by historical standards. This suggests that the corporate credit market isn't overly anxious about a looming recession. Looking at corporate credit spreads over time, widening spreads might sound negative at first glance, but they can be a good thing for investors. When spreads widen, it means investors are demanding higher yields to take on credit risk. For those stepping into the market now, this translates to more attractive income opportunities. Essentially, you're being paid a bit more to compensate for the potential risks, which can make credit markets more enticing for yield-hungry investors. While spreads might widen further as economic momentum cools, corporate credit today is better equipped to handle a slowdown compared to previous cycles. Credit quality in the high-yield market has improved significantly since the Great Financial Crisis, providing a sturdier foundation for the sector. In summary, while widening credit spreads may reflect some economic uncertainty, they can also create opportunities for investors to capture higher income. Despite a strong earnings outlook, elevated uncertainty paired with high valuations poses a risk to U.S. equities. After a robust rally in recent years, the S&P 500 has dropped over negative 4.3% through quarter end, yet valuations remain stretched. For example, the price-to-earnings (PE) ratio, which measures how much investors are willing to pay for $1 of earnings, is still one standard deviation above its long-term average. Elevated PE ratios can signal that stocks are expensive, leaving the market vulnerable to corrections. The Magnificent Seven, overvalued, overowned, and dominant in the S&P 500, are a significant driver of these distortions. While AI could benefit many of these companies, technological change remains unpredictable, adding to uncertainty. Policy proposals on tariffs, taxes, and deregulation further cloud the outlook. For investors, this means avoiding overexposure to the priciest parts of the market and instead considering undervalued sectors. Diversifying into less loved areas of the market can help shield portfolios from broader downturn risks. Global equity market dynamics shifted dramatically in the first quarter, with international stocks outperforming U.S. stocks by the widest margin since the 1990s. However, much of that has been erased in the first few days of the second quarter, thanks to the tariffs. Weak expectations for international markets led to low valuations, setting the stage for this rebound, a powerful reminder that valuations matter, especially with the U.S.'s share of global market cap still near record highs. Sector trends are fueling returns abroad. European and Japanese banks, bolstered by higher interest rates and fee income, are leading the charge. Defense and aerospace stocks in Europe received a major lift from the EU's €800 billion defense package. In China, while the economy remains sluggish, tech stocks are seeing strong gains thanks to better earnings and enthusiasm for AI innovation. Lastly, sectors tied to the growing emerging market middle class, like Indian consumer discretionary and European luxury goods, continue to attract investors. The dollar's recent decline has boosted returns for U.S. investors in foreign markets. As with equities, the dollar had been overvalued, highlighting the importance of considering currency movements in international portfolios. While U.S. equities have historically rewarded overweighting, tides can shift. To navigate uncertainty, investors can diversify across global markets and adopt active strategies to find stronger opportunities while avoiding risks tied to low-quality companies. A well-rounded approach can help unlock higher returns even in turbulent times. As we wrap up this quarter's review, let's take a look at how different asset classes performed through March 31st, 2025. You can see a major flip comparing the year-to-date 2025 returns to 2024. Large cap U.S. equities were the leaders in 2024 and 2023, but are down 4.3%. Only small cap U.S. equities performed worse, but it was the second highest performing asset class in 2024. It was like the revenge of the asset classes. Commodities were the leaders through quarter end, up 8.9%. Developed market equities, with Europe leading the way, was up 7%, showing its value as a diversifier. Emerging markets, with China's strong performance of 15%, was next, up 3%. Fixed income was up 2.8% in only 3 months, while it finished 2024 up only 1.3%. The traditional 60-40 portfolio was fairly flat at 0.6%. That's it for this quarter's economic and market review. Thanks so much for watching all the way through. If you'd like to discuss any of this in more detail or anything else about your investments, don't hesitate to reach out. I'm always here to help.